And it's great to see so many of you join us today, both in person and online. My name is Josu. I'm a partner at Shing Mortgage, and I'll be your host for this session. Today, we will be diving into one of the hottest topics pretty much on every investor's mind, the Melbourne property market. And with shifting market conditions, recent rate cuts, and new growth corridors emerging, understanding where to invest and how to approach financing has never been more important. Now, to help us make sense of it all, I'm thrilled to introduce our guest speaker, Rich Harvey, the CEO and the founder of Propertybuyer, and one of the most trusted voice when it comes to turning the property goals into realities. And Rich has been in the business for over 25 years and an incredible 49 awards. And but rather than me listing all his achievements, Rich, why don't you kick things off by sharing a bit of your journey and what drives your passion for property?
Yeah, thank you, Joe. Thank you, William, for hosting today. I really appreciate it. It's great to be with you both online and in the room in person. I guess what drives my my passion for property is that I just love helping people to make good property decisions at the end of the day. So it's all about helping people understand the market. And in my motto is actually helping people make better property decisions. I've seen people make really bad property decisions and people make lots of mistakes or never really get on the property ladder. So I created my business off the back of trying to create a portfolio for myself and build wealth for my family. And so I've learned a heck of a lot along the way. Made some mistakes, and I teach my clients not to make the same mistakes, but I love teaching people how to make significant wealth, which can really set up intergenerational wealth for your families, which is a pretty cool concept. I really started to help clients build really massive wealth, which they can then pass on to their family and their family's families down the track.
Excellent. Well, thanks for sharing your journey, Rich. And it's clear why you're such a trusted name in the industry. Now, speaking of the property and finance, I'd love to bring the conversation back to something that has been making the headlines, that the recent RBA rate cut. And it's the first drop we've seen in a while. And let me tell you, the impact on the market sentiment has been immediate. So from my side, the shift has been very obvious. The confidence is back. My phone hasn't stopped ringing. And the investors, first home buyers, upgraders are all reaching out. And that's a real sense that the market is picking up momentum again. Now, but what does that rate cut actually mean for borrowers? Let me break it down. So for someone on the principal and interest loan, the 25 basis points cut translates into around $160 less per month on $1 million loan size. And for interest-only loans, the savings about $209 per month and for the same loan size. Now, when it comes to borrowing capacity, that's a bit of a reality check. The increase is roughly about 2.5%, and while it's a step in the right direction, it's not a game changer for in terms of what you can borrow. So, Rich, from your perspective, how do you see this rate cut implicating the buyers' behavior and the broader property market? Have you been noticing the same momentum on your side?
Yeah, look, we've all been expecting a 0.25% rate cut. You know, the financial markets were pricing in a 60% chance, then a 75%, and then a 94% chance. And of course, we got it in February. We're all expecting it, which is great, but it hasn't fundamentally changed all the market dynamics yet. What this first rate cut is restore confidence. It's restored a bit of confidence, so a bit of more positive sentiment. When we get a second rate cut, that's a bit more material, but a third rate cut starts to become substantive. So to your example, on $1 million loan, obviously every 1% cut, total of 4 cuts, right? That's a $6,000 saving roughly, right? But divide that into 4, $1,500 a year, you know, that's, you know, probably a coffee a week, right? You know what, like, so it's not massively different, but what it does allow more investors and more buyers back into the market. Each cut we get, you're going to see more and more home buyers, more and more investors come back into the market. So it will start to re-accelerate the market, but not at the same rate we saw during COVID when it went crazy.
Perfect. Well, thanks for that, Rich. And it's clear that the rate cuts brought a new wave of energy into the market. But alongside that excitement, there are still some significant challenges, especially when it comes to borrowing capacity and the repayment pressure. Now, the reality is, while the buyer's confidence has definitely picked up, the lenders are still assessing applications very cautiously. And with the property price on the rise, many borrowers are finding themselves stretched to the limit. And that's why having the right lending strategies in place is more important than ever. So let me quickly share 2 of the most popular solutions we're seeing right now. The first one is the SMS lending. So this is a powerful way to leverage your super for property investment. Not only does it offer tax advantages, but also it allows you to borrow within the SMS structure, and which significantly increase your borrowing capacity, and especially if you already max out what you can borrow under your personal name.
Can I just jump in and make one point, if I
Yes.
may, just on that? We're seeing that too. We're getting an increase in inquiry for people buying using a self-managed super fund, because to your point, it resets your borrowing capacity. I think that's the fundamental difference. When you're buying outside of super, you've just got your income.
Yes.
You're buying within super, you got a whole brand new ability to borrow, right?
Yes, and well said. And usually we at Ting Mortgage or property buyers, we work with a group of professional networks, including solicitors, accountants, even financial planners, to help people want to invest under SMS. Perfect. Now the second strategy, it's a quite funny one. It's called an endless borrowing capacity strategy. If you watch our Red Notes or the online social media, William has done a lot of videos around that. So the approach involves using trust structure to purchase investment properties, and by keeping these loans separate from your individual names, you can protect your individual borrowing capacity while continue to expand your portfolio, which sounds easy, but it's very complicated. Yeah. So that's the two interesting strategy. Now, what's really encouraging though is the current market lending sentiment. The lenders actually want to lend right now, which is a good news, right? And they're obviously working within the APRA's framework, but finding the ways, trying their best to ease the requirements wherever they can. So two of the most standout recent examples, including the one-year financial for the self-employment borrowers. So more lenders are now accepting just 1 year of tax return instead of 2. So this is a game changer for business owners like who has just bounced back from after, say, COVID or the previous downturn. Then now they can basically borrow more and quicker under this new policy, which is great. The second one is expanded a professional MI waiver list. So essentially, more occupations are now qualified for the higher borrowing capacity without land and mortgage insurance. And taking nurses, for example, who are usually on solid incomes but don't really have time to, doing their research for loan options. Now they can pretty much lend secure loans with less upfront cost and more flexibilities. Now I've kept this high level without slides because, honestly, if we went into details, we'd probably be here all day today. But if any of these strategies or updates caught your attention, or left you curious, feel free to drop in your question in the Q&A section, and or just reach out to us after the session, and I would be more than happy to dive deeper with you. Okay, perfect. Okay, so the conclusion will be, while the challenges still exist, the good news is that the smart strategies and lender flexibilities are making it much easier for borrower to navigate the current market. Now, Rich, from your side, have you seen any recent challenges or hurdles your clients are facing when they're trying to secure your finance?
Any recent hurdles? Well, I think a lot of people come to us and they go, look, I'm struggling to get finance. And often it's because their income is just fixed or very low. It doesn't quite meet the threshold. And obviously you've got to meet that APRA 3% buffer rate, which is a bit of a pain. I reckon that should be reduced to 2.5%, to be frank. That's one hurdle. I think the other hurdle is just in people's minds, Joe. I think people are just waiting for something to happen. They're waiting for the perfect conditions. They're waiting for the wind to stop blowing, or the headwinds, or the headlines to ring a bell and say, now is the perfect time to buy a property and borrow money.
Yes.
Right. But I can tell you now, you won't see that headline anytime soon or ever, right? There's never a perfect time. It's just got to be borrow as soon as you can borrow. I think one of the fundamental things a lot of investors do is procrastinate, and that costs a lot of money. The opportunity cost of waiting until the perfect conditions are there, where you think interest rates are going to go back to 2%, which won't happen, is just false thinking. So I think the challenge is getting the right mindset and having the right team around you and the right education to be able to make a considered decision to invest and buy.
Yes, perfect. That's a great perspective. And in terms of the 3% buffer rate, I think that's one of the hottest topics the APRA and the major banks are discussing at the moment. There's a lot of voice, they are asking the APRA to lower the buffer rate to make life easier for everyone, but I think that's going to be a tough one for now. But thanks for sharing, Rich. And at Ting Mortgage, that's exactly where we come in, where whether you're a first home buyer or an experienced investors, or someone looking to navigate a complex structure, we've got you covered. Our specialties lies in tackling the complex lending solutions, SMS lending, and the commercial lending space, helping our clients structure loans in a way that supports both of their short-term goals as well as the long-term wealth building strategies. But of course, smart lending is only one side of the equation, and the other is knowing where to invest and what to invest. That brings us back to today's main topic, the 2025, the Melbourne property market. Now, Rich, I'll hand over to you to walk us through your insights and what trends are emerging, which areas are showing promise, and how can investors position themselves to take advantage. Of course, just a quick reminder for everyone just tuning in, if you have any questions at any point, whether it's about lending or property, just drop them in the Q&A section of the Zoom software, and we will have a dedicated Q&A session towards the very end to answer as many as we can. Okay, all right, Rich, all over to you.
Thank you so much. And just checking, Yuki, I'm in the main center of the frame for everyone at home. That's all good. Just double check.
Looking perfect.
Shoulder to shoulder space. All good. So look, lovely to thank you again for the opportunity. I've got quite a lot of data to get through today, everybody. So bear with me and feel free to take notes, but we will be sending these slides around as a PDF that you can also study and get to later. Now, this has taken me literally many hours and days of preparing these slides. They're all fresh slides. So I put a lot of effort. So I do hope you get a lot out of it today. So I'm going to do a couple of things today. We're going to look at the market, where it's at the moment in Melbourne. We're going to look at the specific drivers of the Melbourne market. We'll be looking at price predictions, both in Melbourne and nationally. Talk a little bit about how a buyer's agent might help you on your journey. Look at some case studies, and then we're going to open it up to the Q&A, which is always the best part of these presentations, because I'd love to hear your particular questions, please. So do drop them into the Q&A box, and we'll address them very much at the end. So let's have a look at where Melbourne is and where it's heading. So here's a headline. And again, you don't believe everything you read in the media, but they are on the right track. This headline is saying the worst may be over. So Melbourne is pretty much a serial underperformer, pretty much, since COVID finished. It had the worst lockdowns. Its economy is, very much indebted compared to the other states. So we'll get into it. Let's firstly just have a look at median prices across each of the capital cities. So my eyes aren't so great, but you can probably look at that fairly closely. These figures are sort of toward the end of last year, a little bit conservative. So these are the core logic figures, which are different to Domain. Domain have higher numbers. It's just the way their data sets work. So Sydney's median is about 1.45. Domain's number is about 1.6. Melbourne's median at the moment is sitting around 920, but actually Domain's number is about 1 million. But what's interesting is Brisbane is now exceeding Melbourne. Like, that's never happened. And normally the main thing to point out in this chart is the differential between Melbourne's price and Sydney's price. It's like, 60%, 50% cheaper. It's unbelievable. It's never been that far apart. So I don't believe it's going to stay at that level for very much longer. So watch this space. All right, so what's been the price changes across each of the capital cities? So you can see here that Melbourne has unfortunately gone back to 3.3% since the last 12 months. Sydney hasn't really gone up substantially. Perth has been the standout market. Adelaide and Brisbane also very much standout markets. So again, if you are looking and suddenly going, where will I buy my next property based on this chart? I wouldn't be using this chart to pick your next location. There's far more many fundamental factors. And again, don't just buy it on the basis of 1 year growth. Look at it over a much longer period of time, and I'll show you a chart about that later.
But 70%, that's crazy.
Yeah, I know, it is crazy, yeah. So you can see, look, some of the cities tend to follow each other, but obviously Perth is a bit of an outlier there on the right, and it's had other drivers going forward. So let's have a look at how the Melbourne has had the really weakest trend. And you can see here, Sydney's been, obviously, all cities pretty much had a dip after COVID. They all had a spike not long after COVID hit. COVID was amazing for our business in particular. Like, the market just took off far more than anyone expected, because everyone realized they couldn't travel and they spent more on renovations and needed to buy, bigger property because the kids were driving them nuts and they needed more space, whatever, right? So all of those factors contribute to that. We also had very little migration into the company, and then into the country. Now we've had a massive spike in migration since then. So, but Melbourne, as we say, has had the weakest level of growth so far. If we look at cumulative value changes here, you can see that, since COVID, since January 2020, Melbourne over the last 4 years has only gone up 7.8%. So it's very unusual, is what I'm saying. Again, if we could look at this chart over a much longer period of time, obviously Perth's gone up the highest, then Adelaide, then Brisbane, Canberra 29, Sydney 27%, Hobart 26, Darwin 25. So what I'm saying to everybody here is that if you are looking to invest in Melbourne, it is probably the #1 counter-cyclical opportunity to buy right now, because I do believe it will revert more to the mean and more to the averages as we go, and I'll explain why in a moment. So we look at, again, just a hotspot map. If we look at the change in values, you can see the dark red areas, it's had less than 5% growth. The sort of reddy areas, 0 to 5% growth. So there hasn't been any, you can't see much blue in that chart, right? So the blue will typically say 5%, up to 5% growth. So there's not a lot of chart. But what I'm saying to you, if we were to do this seminar, say again in 2 years, come back to this room, let's put this same chart up, Joe, and let's see what the color is. I think it'll turn blue, right? It'll go from don't invest to absolutely invest.
Fingers crossed.
Yeah, no, it absolutely will. I'll be investing there. So the one good thing about Melbourne is that compared to a dwelling value to income ratio, so yeah, typically you've got to have 9.8 times income to buy an average property in Sydney. In Melbourne, you only need 7 times income. So the good news is Melbourne is slightly more affordable than the other capital cities. So that's just one little silver lining that we've got there on the horizon. All right, let's have a look. Oh, and the percentage of household income as well. So again, that just translates, a massive 62% of your income to hold a mortgage in Sydney. That's why there's definite mortgage stress in Sydney. That's why you see a lot more people renting rather than buying at the moment. And it's going to be a continual problem. You know how the average is, right? There's 30% own the home outright, 30% paying off a mortgage, and 30% of renting.
That's right.
I actually think that percentage of renters is going to expand to about 40%. I was reading an article in today's Fin Review. Over 50% of people in Germany are now renting. So particularly in Europe, again, same sort of issues over there. There's not enough incentives to build private accommodation. The incentives that the government taxes a lot of investors out of existence. So the same issue is going to have here. But don't get under my hobby horse about property taxes, right? It's another webinar. All right, let's have a look at vacancy rates. So Melbourne had a bit of a spike in vacancy rate during during part of the COVID period, got up to like 5%. But look at the vacancy rate now. We're looking at it roughly now around 1.7%. So it's a pretty low vacancy. So again, the rate of change or the rate of annual rent growth, it went up to like 10%. I've been tracking a lot of these figures. Units, look at that. Units went up to 15%. So massive spike in rent. So tough news if you're a renter, great news if you're a landlord. So as an investor, don't expect rents to go up 10 or 15% next year, right? Typically it's getting back to its like 3 to 4% CPI kind of increase. But the good news is rents have really ratcheted up, which does make it a more cost-effective equation for buying an investment property in Melbourne. All right, so let's have a look at some of the reasons why Melbourne has been weaker. As I said, we've seen on the demand side, there's a lot of demographic factors that's mean it's a lower demand there. We've seen higher state debt. As I said, the state government is very much indebted. Their lockdowns were very draconian, really had a massive impact on businesses and a massive impact on the employment structure. Also, they slightly raised the land tax. Now, it's not a massive increase in land tax, but this has kind of been blown out of proportion. So a lot of people that weren't paying that much land tax are now paying somewhat more significant land tax. And I've got a chart a bit later on about the rental bond board showing how many people have actually sold their investment properties in Melbourne and exited the market. So there's less rental properties in the pool there at the moment. Also, we just haven't seen the off-the-plan building that there usually was. I mean, the government did just introduce a zero stamp duty for off-the-plan purchases, but off-the-plan buying is generally on the nose around Australia because of people's perceived perception of developers not building high-quality stock. So that's been challenging. As we say, there's been conflicting demographic trends. We obviously had a massive drop in population growth. We saw a lot of people exit out of Victoria during COVID and go to particularly Queensland. That had definitely a very, very strong spike. But we're starting to see it sort of normalise now. So interstate, as I say, migration fell to record levels, but it's kind of getting back to its more neutral level now as we go forward. Here's the land tax rate. So just so you can see what the land tax are, up to a land value of 50,000, you pay zero tax. Between 50 to 100,000, you pay $500. Between 100,000 to 300,000, you pay $975. And then once you get 300 to 600,000, you pay $1,350 plus 0.3% over that amount.
That's why it's really low.
So yeah, that's right. So it's the lowest of all of the states, which is interesting. But when you still compare it to, say, New South Wales or Queensland, it's not that bad. So as I said, it gets blown out of proportion in the media saying, oh, they've ratcheted it up to ridiculous levels. As I say, it's not when you actually do your calculation, it just captures more apartments, which have a certain proportion of land value. So they're trying to cast a wider net to. And again, who's to say that the state government gets changed and this won't be modified again in the future? But they've got to find some other way to raise taxes in the country, in the state. Here we go. This is the chart I was telling you about rental bonds. So there's been a massive change in sell down of residential investment properties to either owner occupiers or other investors. So the amount of security bonds that were held by the Bond Authority over the last 3 years has fallen by 4.5% last year. So that's a significant drop. You can see that red line there on the chart.
So really big drop. A lot of investors get rid of their investment property because of the policy, and less applies for the renters. Okay, that's right. Great.
Yeah. So that's going to exacerbate the vacancy rate going forward. So very significant.
Excellent. Well, thanks for sharing those insights. But I guess a lot of the investors are always looking ahead, right?
Yes.
And we've been talking about the overview of the current Melbourne property market landscape. But people would like to know that looking ahead, what are the key indicators or events that investors should monitor to stay ahead of the Melbourne evolving property landscape?
Sure. So let's talk about, I guess, a couple of drivers, and then we'll get into the individual sort of where to buy and what to buy in a moment. So future market drivers is just going to be obviously migration into the country. So migration from overseas, not interstate migration from overseas. So this chart shows we had a massive drop off in migration during the COVID period. Then we had a massive increase of we've had almost, excuse me, 1 million people come into the country over a 3-year period. Never, unprecedented. Not since World War II have we had that many people come into our country. So, and we just obviously not building enough properties. So it's been a crazy, crazy time. So we are seeing now a more normalized migration rate, which we're expecting, 255,000. I think it's probably it's still at around 300,000, 350,000 a year at the moment. The problem is if the government turns off the tap too hard on migration, we continue to have a job skill shortage. So we become a less productive country. So this is the dilemma, right? The ministers are sitting around the cabinet going, we need more jobs, we need to create more productivity for this country. We need more people. But at the same time, we're just turning the tap on and exacerbating the housing crisis. So it's a very, very difficult debate to have.
I guess with the upcoming election, this is one of the debatable questions in place. It's going to be a hard one.
Exactly. So that's the long-term chart of Australia's migration, back since World War II and World War II. So you can see we've had, as I said, unprecedented numbers of migrants coming into the country. And here's Australia's population forecast. So I tried to do it as a simplistic chart as I could. We got the stats from both the ABC and Treasury forecasts here. So we're currently sitting at around a country of 28 million people, right? We're now expecting to see that to be around 40 million by the year 2050. So that's a, $30 million people increase, right? So I've got a question for you. Where are we going to house all these people? Right? So
that's a good question.
You've got a spare room at your place, I guess. Okay. So, there's a big challenge there, because the other issue is, I should have put this chart up, is the average household size has actually declined. So it was 2.6, now it's about 2.4 persons per household. So we're starting to see we actually need more dwellings, but even smaller dwellings to cope with the demographic changes. So that's just a big point to watch. And again, where are we going to put all these people? Most people in Australia live in coastal areas, because obviously we have a very hot climate in the centre, and most of them live in the capital cities. So it's going to be interesting to see how that all plays out. All right, let's have a look at factors, individual factors that's driving Melbourne's market. So I've tried to break this down as best I can. So a couple of things. Number one, I said population growth. Melbourne is actually now larger than Sydney as a total number. They changed some statistical boundaries recently, and Melbourne is now slightly larger than Sydney. So the debate between Sydney and Melbourne, it's finally Melbourne's won that debate. We have a nicer city though, come on. Well, I think I've just put some people offside online. No, they're both wonderful cities, I have to say. My wife came from Melbourne, so very good things on from there.
That's not good.
Investment infrastructure. So you've got some major infrastructure projects like Suburban Rail Point, Loop, the Airport Rail Link, and the major upgrade the roads. Like, the thing in Melbourne I love is the road network. To get anywhere is just so much more efficient than the Sydney mess that we have here, even though we've got new stuff going on in the metro here. But, their infrastructure is really great. We still have a major housing supply demand imbalance. You've got low levels of approvals and rising numbers of migrants and renters. So that's going to continue to be a pressure. So if you're thinking of investing in Melbourne, you can think very positively that you'd be easily able to rent your property out. There's no reason to think you're going to have a major vacancy. Other big factor is just generic interest rates and lending policies. That just has a generic impact. But then specifically policies around any kind of grants or stamp duty exemptions or build to rent initiatives, that will also have an impact. So the build to rent sector is starting to get more traction. There's a couple of big institutional players that are going to be building, literally thousands of apartments, and they won't be selling to individual investors. They'll be owned by like a sovereign wealth fund or a major, like a BlackRock or something, that will actually own these build to rent properties. So that will help to satisfy some demand, but nowhere near enough satisfaction.
And that's interesting on the last point, because I've been getting a few phone calls from my existing clients. They're all sophisticated investors, and they start talking and asking me about the Melbourne property market. And one of the views they're taking is in the event of the government change in the next election, and if the new government actually have a big major shift in the policy and abolish all the previous one, they believe there will be a big increase, or let's just say catch up in the Melbourne property market. Do you think it's like a real sort of a substantial way to look at this?
Yeah, I do. I think if you just look at Melbourne as, now it's like it's a counter-cyclical investing. We're buying at the low point of the cycle. They've really disincentivized a lot of investors to go there. So I know it's hard to go against the herd and think about investing in Melbourne and buying in Melbourne. But honestly, I think the long-term benefits, you're literally buying now at a significant discount.
Right.
And I'd say to a lot of investors, some are very impatient. They go, okay, if I buy in Melbourne in March in 2025, what's it going to be? Is it going to be
quick money?
Am I going to make 100 grand by December?
Right.
Well, maybe not, probably not. But you know that if you hold it for a 7 to 10 year period, you're going to do very, very well.
Good point.
There's also a major construction issue as well. Just construction costs have gone up. There's a lot of competition for private industry and infrastructure trades versus building for residential construction. So trying to get trades on sites is also challenging. That's another factor.
Cool. Okay, well, I think given the current market trends, I think a lot of our investment clients are actually particularly interested to understand more specifically which Melbourne suburbs do you believe are, at the moment, like you said, undervalued and the points for growth before reaching the $1 million median price mark. Can you share a bit of light on that?
Love to. Here's the goal. Okay, here's what everyone's been running for. Some drum rolls, please. Right, so a couple of things I want to talk about. I'm going to sort of break it into a couple of rings and corridors. So what I talk about is the inner and middle rings. So what I talk about is gentrifying suburbs that have got strong owner-occupied demand. So I like to buy in suburbs where there's, 65, 70% owner-occupier versus 30% renter, rather than the other way around. Because then when you're renting your property, you don't have as much competition. So places like Footscray, Brunswick, Preston, Coburg, Box Hill or Bulleen. So they're our sort of couple of picks I'd go for those inner and middle rings. So in terms of growth corridors, these are kind of what I call the real affordability corridors, where there's new infrastructure, new roads. They're a fair way out, but they're definitely growth corridors. So Mickleham, Tarneit, Werribee, Cranbourne, Watsonia, Carrum Downs, and Craigieburn to the north. So take Carrum Downs, for example, in the southeast, down toward Frankston area. It's currently got a median house price in that suburb of $700,000. But if you look at some of the surrounding suburbs, like Frankston, which has a median price of around $1 million when you're closer to the water on the bayside, it's so much cheaper, and yet 5-10 minutes drive. So Carrum Downs, for example, you've got a yield of around 4.4%, really close to the beach, close to Sandhurst. You've got some great golf courses, good walking areas, and really nice affordable homes on good sized blocks of land. So we've been buying properties in that sort of 750 to like 900K range, 3-bed, 4-bed homes. We believe they're going to be, doubling in value in the next 10 years. That's a great investment. Also more premium areas, so places like Brighton, Hawthorn, Melbourne, and Toorak, obviously. And I'll talk about buying apartments even in those areas as well. And then you've got your regional and growth spot areas. So Geelong and Ballarat showing some pretty decent returns in terms of yields, and down toward the Mornington Peninsula from a great lifestyle perspective is something we highly recommend. Yes. So let's talk about the middle markets a little bit more. In that sub 1 million market, it's very competitive because, again, it's more affordable. You've got both first home buyers, upgraders, downsizers, and investors all searching for that kind of stock. So be aware that when you're buying in that, don't think you're going to be the only one turning up to the auction. Having said that, there's not a major number of people at auction right now, but as the year progresses, you watch the numbers absolutely increase. In that middle market, that sort of 1 to 2 million type range, we're seeing prices have stabilised a bit, but again, really strong demand in that family-friendly suburbs. But properties above 2 million, we've seen the market soften quite significantly. So a couple of suburbs to watch that I recommend: Glen Iris, Camberwell, Bentley and Newport. The reason we say that, we're seeing a lot of upgraders and expats returning as well.
That's a good point. Just one little quick note on that is I think in Sydney we're experiencing pretty much a similar trends. Is where the entry-level house, anything between 1 million to 2.5 are highly competitive. But anything like sort of middle market, a bit more luxury side of things, like a 4 to 5 or 6, it's definitely coming down. It's very obvious. Probably I think it's because of the high end of the market. People move their funds from overseas, and also they are more sort of subject to the change in the lending scape, so they're more affected by that. Yeah, so exactly. It's the same trend. Interest rates, I believe. Yes.
Excellent. All right, and then in terms of the luxury market, as you just pointed out, the upper end of the market is a lot less exposed to interest rates. Like they're buying with cash most of the time. They don't typically get very large mortgages on those sort of properties.
True.
And some of the best suburbs, like Toorak, Brighton, South Yarra, Kew, Canterbury, all absolutely prime suburbs. Again, if you've got the money to buy there, you do well. But if you've got a $3 million budget, I wouldn't be buying just one property in Toorak, for example, if you can find one. Right, I'd be buying in other areas. So again, every client is different, and every strategy needs to be tailored to whatever your situation is. Yeah.
And I'm curious that how's the luxury market performing in the current market in Melbourne? Are they still performing strongly or same as the other?
It's a very mixed results. Right. As I say, I think it's actually a really good time to buy.
Okay.
And I'd say I just went to Singapore recently in January and talked to a lot of expats over there. And a lot of them are trying to get their funds, either in US or Sing dollars, back to Australia because our exchange rate is so favorable.
That's right.
Like if the dollar's at what is that, 62 cents or whatever, you remember when it was 94 cents, right?
Yes.
If you can get an extra boost in your borrowing capacity because of simply an exchange rate, happy days. So I'd be getting it back, and we're getting a lot of expats now thinking now's a good time to do that transfer. Great time, market's a bit softer, either Sydney or Melbourne, really take advantage of that. But we are seeing a lot of expats coming back, international buyers as well. And they really want those blue chip suburbs.
Good point.
So I mentioned apartments. So a question I've often raised is, do apartments represent good value buying? And I've got some examples, and the answer is absolutely yes. Now, I'll show a slide a bit later about the differential between buying an apartment long-term versus buying a house, and just what the difference in capital growth will be. But the reason we're saying apartments in Melbourne represent excellent value at the moment is you can buy a property at almost 80% land value. So it's significantly cheaper to buy something. So in that sub 1 million bracket, you can buy something for like 800,000. And of that 800,000, 80% of that number is represented by the land value of the apartment.
Are you referring to the second-hand, like the
established, totally established, not the brand new?
Yes.
No. I would not recommend buying brand new in Melbourne.
Right.
No, you're paying a retail price for that.
Yes.
Far better to buy established property, because you can't even rebuild the apartment for 800K. Like to build a two-bedder now these days costs 800 grand. It used to cost 400 a box. Right. Now it costs 800 a box. So you can't even buy. So you're almost buying, the apartment comes for free. You've got the land, right? And we're seeing rental demand is very strong. So you'll always have a really great supply of tenants. But again, I tend to recommend don't buy in those really giant blocks like Docklands or South Bank. Buy in the boutique, older style apartments, and doing a small reno on the kitchen or bathroom. That's gold if you can do that.
Yeah. And a quick comment on that is where a lot of my clients, they are after the apartments, which is a big concern, mainly in Sydney. I'm not sure how Melbourne reacts to that, but there's a lot of cladding issues, a lot of strata issues. And as a buyer's agent, what sort of red flags the buyer should look into before they do their game plan?
Well, first thing we always do, we help the client to get a strata inspection done. Right. So you make sure that it's not, clad with really highly flammable cladding, and there's an council order to have it removed, and it's going to cost $100,000 special levy. So you always make sure you do that due diligence before you go unconditional on contract. Right. So typically you like to, the brick apartments are great, right? Double brick, they're really older ones, they're really well built. So just do be careful if you're buying. They tend to be in more modern apartments, like stuff built from sort of the 90s onwards, rather than stuff built in the 60s and 70s. So, but always make sure you get a strata inspection done or a building inspection done before you buy.
Good point.
So another little pearler I'll give people is granny flats. Now, I'm a big believer in granny flats. I've got several myself, and the question is, can they work in Victoria? It's not really a big thing in Victoria yet, but watch this space. I'm trying to set the trend here, okay? As an investor, I'm always looking for a way to get two incomes out of the one property.
Yes.
Now, there's not a lot of granny flat providers yet in Victoria, yet they've just changed the law to now allow a self-contained second-hand dwelling with council approval in most areas. If you're buying in Sydney, or sorry, New South Wales, you can build a granny flat anywhere up to a 60 square metre dwelling, and you don't need council approval. It's what they call a compliant development. In Brisbane, there's only certain councils that will allow a granny flat. So again, you've got to be very selective where you do it. Good news about Victoria, again, you can do it anywhere in any suburb as long as you've got the right setbacks. So I think it's going to work best in those middle and outer rings. It won't work. It's going to be too squashy or too difficult to build and too expensive to build in those inner city areas. But the middle and outer ring suburbs where there's still really good demand for rentals. Yeah. And again, highly affordable. But the ROI you get, like if it's going to cost you, say, 200 grand to build it and you make $400 a week, I mean, yeah, that's a fantastic yield. Yeah, right? Just got to boost the overall yield on the property.
That's right. And I've got a really good story, real life story. It's one of the national top 10 agents at Ray Wire. I'm getting really close to. He's got a portfolio of about 9 or 10 properties. Apart from the PPSR, all the rest are actually a proper house with a piece of decent land with granny flat. And looking at his portfolio and the rental yield has been crazy, amazingly good, right? Obviously, the something from the lending perspective is that with the granny flat, it has to be council approved. Otherwise, the lenders may have a problem with you. So if you're not sure, just talk to us before you pull the trigger. So it's always good to be double checking before you action the plan. So
yeah, great point. Excellent point. And the other thing that was just announced last weekend, so this is hot off the press, is what they call Melbourne Pilot Activity Centres. So similar in Sydney, where they've got what they call TOD areas or transport orientated development areas. But in Melbourne, these pilot activity centres refers to a designated area that's going to be used as a trial site for new planning and development rules. So the idea is to increase the density, typically around train stations or bus stops, and they're going to have a mixed use zoning. So typically what it's going to end up is you'll increase density from around 4 stories to 6 stories to even higher, depending on the location. So the key locations here where this is going to happen or has been designated is Broadmeadows, Epping, Frankston, Ringwood, Camberwell Junction, Chadstone, Moorabbin, Niddry Keilor Road, and North Essendon and Preston. So that'll just be something to watch. And again, it may not apply to everybody here who's maybe not so much into developing, but just be aware that these areas will have a higher density, and that's going to create more interest from renters and other businesses in these areas.
And I've got an interesting question. I think something similar to the new policy in Sydney. What do you think the implication of this new policy change would bring on the value of the house in those areas?
Oh, absolutely, it'll increase it. Absolutely. Increase it. Well, if you are directly in this area, right? Even I know some people that they were only allowed to build 4 stories.
Yes.
And now they can build 6 stories.
Right.
So that automatically increases the value of this land. Yeah. Whether he actually develops it or not, it's going to depend because again, construction costs. You just got to do a feasibility to say, is it the right time to build that kind of product? Right. Will the market sell? Will you be able to sell 100% of the product that you're building in that area?
Yep.
So it definitely increases that.
Right.
Cool. Let's have a look at price predictions.
Yeah. Okay. So how does Melbourne property market compare to other Australian capital cities in terms of the growth potential and investment opportunities? Because investment is all about opportunity cost, right? We have a certain amount of money I want to invest and I want to see where it gives the best return. So how's that? What's your insights on that?
Let's have a look. Okay, so we've got a couple of things here. So I'm just going to go through, I'm going to compare my own price predictions that I'm going to put up with Domain, and let's have a look. So this is Domain's house price forecast. They just released this in January this year. They think that Sydney will do around 7%, Melbourne just a measly 1%. I think that's a bit way too conservative in my view. Brisbane 7%, Perth 9%, Adelaide 8%, Canberra 2%. So they're the numbers for, and they've got their figure for what they think that the end value of the median house price will be in each of those states as well. So yeah, all very positive. I'm not seeing any negative numbers there, Joe.
That's right. Sounds good.
And let's have a look at unit prices. So they think Sydney will do 5%, Melbourne will do 3%, Brisbane 5%, Perth around 4.5%, Adelaide 5%, and Canberra say around 2.5%. So again, all positive numbers, a bit lower in terms of the capital growth, but all very positive. Now, here's my predictions myself. This is what I'm believing that the market will do. And you can again test me again, just have a chat in 12 months' time and see if I'm right. This is just a 1-year estimate, right? Calendar year of what I think prices will do in Sydney, Melbourne, and all the other capitals. So I think Sydney will go up 5%, Melbourne around 4%. So I'm not saying Melbourne's going to really race ahead. I just think it's going to be steady growth.
Right.
It's not going to have massive growth. But I do think watch the following year and you'll start to see much more significant growth going forward.
Right, sounds very positive. Yuki, can we do a screenshot of this slide to make sure Rich is accountable for this? All right.
Yeah, put a gun to my head. Right? See if I'm right. Yeah, but I do think, look, Perth is still going to go very strongly, but then I do think Perth is going to flatline pretty quickly after 2026.
And what's the reason?
Oh, it's a unsustainable growth. Like again, Perth is very tied up to the resources sector.
Yes.
So 75% of employment is all related to mining. Yeah, if we continue to have a mining boom, great, right? And the Perth has definite housing shortages, but the rate of growth is going to absolutely slow down. It's like a lot of things. They reach their peak and then they flatline for quite. But Perth tends to have these long periods of no growth. So what I say to my investors is, look, you can by all means buy in Perth, it's fine, but just be aware that if you wanted to sell your property 5 years from now, it could be a pretty depressed market or a pretty average market. Whereas you buy Sydney, Melbourne, or Adelaide, it could be a better market to be buying.
Excellent point.
Okay, so let's have a look. Here we go. Oh, we should go back one. I need to do the drum roll, introduce this next slide. Right? So there's a bit of context to this one.
Yes.
What I've done in my next slide is I've taken the current median house price. Yeah, I'll put it up. Here we go. Put it up. I've taken the current median house price that CoreLogic have given us for today's numbers. This is for houses, and the next slide is apartments. I've also looked back 20 years. And 25 years. And you can see the median value of what it was back in 2005. Then I've estimated the annual percentage change over a 25-year period. I've actually done a 25, even though I've only got a 2005 figure for 2005, I've actually done 25 years worth of data. So these numbers show that Sydney has gone up 7.3% per annum on average. Melbourne has gone up 5 years. Wow. Melbourne has gone up 7.4% per annum on average. Brisbane has gone up 7.5% on average. So if we extrapolate this out, just simple maths, simple compound growth, it means that Melbourne's median house price at 917,000 at 7.4% will be almost 3.5 million in 20 years' time.
Wow.
Are they crazy numbers? I think, are we playing Monopoly? What's going on here, right? So like often you look at these numbers and go, oh, come on, that's not true. Well, think back. Let's go back to 2005. Melbourne's median, 358,000.
Unbelievable.
So now basically the domain number is saying it's over $1 million.
Right.
So in Sydney, we're saying a $1.47 million median will become $5.47 million.
Wow, that's amazing.
That's crazy.
Yes.
So it's just simple math, simple compounding growth. I mean, obviously, the value of your dollar, the value of your wages is all relative as well. I don't believe wages is going to keep up. That's always going to be a problem. But what this chart says to me is, wow, the cost of waiting to go into the market is huge. The cost of procrastination is huge. This motivates me to go and buy a lot more property for myself and build my own portfolio because I want to harvest that equity to use buy more properties.
Yes. But while having saying that is that the obviously the market is up and downs, and it's just the average figures.
It's an average figure.
It obviously tell us because no one can actually predict the market. So the earlier the better. I guess that's the message. Yeah,
I mean, some years Sydney might do 2%, but some years it might do 15%. Melbourne might do, as we've seen, gone backward 3% last year. Guess what? It'll probably do 15% in the next couple of years, and it might do that for 2 or 3 years. So the earlier you get in and can ride that wave, the better. Right. I don't want to be standing in an auction, in a year where there's 15 people bidding and I'm spending a crazy number to get into the market. I'd rather get in now when it's not as crazy and hold it as long as I can sustain my cash flow.
Right.
So let's have a look at, just bear in mind those middle figures there, of the percentage change over 25 years. Let's quickly go to units. Let's have a look at that. So you can see the unit numbers are lower than what you get for houses, typically around 2% on average lower. So Sydney's prices only went 5.3% up on average, Melbourne 6.1. So a Melbourne unit back in 2005, 292,000. Currently at 607, will then be $1.65 million in the year 2045 on an estimate. Sydney's unit values are going from say 860,000 to about 2.2 million.
Yes. Yeah. While the return is slightly less than the house values, but because the entry is relatively easier. So for professional investors or first home buyers, you can still
make great money. Absolutely,
the market.
100%. You still get access. So this answers my question: should you buy now or should you wait?
Yes.
Well, you can answer that yourself.
Yeah. Perfect.
So I just want to really briefly touch on just what we do as buyers agents and I guess some capabilities we have and the kind of services we can help. And then I want to touch on some specific case studies that showcase Melbourne and some of the strategies that we've done. So as buyers agents, we provide a whole raft of services, typically a full search. We appraise, we negotiate, we help you create a strategy around what you're looking to buy. We do all the negotiation and option bidding as well. So our typical clients are residential investors, first-time investors, through to highly professional and experienced investors building a whole portfolio. We help home buyers, we help prestige buyers, we help commercial buyers, and people buying their self-managed super fund. So these are the 7 steps to buy well. Even if you do this on your own without a buyer's agent, these are the 7 steps you should be taking. Firstly, you've got to create a strategy. A lot of people just go, oh, I've got a pre-approval from Joe, I've got 900, what should I buy? Realestate.com, what can I buy? Without thinking what city, what location, what street should I buy in, and thinking what's the strategy. So really get that strategy piece is essential. We provide that for our clients. We then give our clients research and recommend a specific area based on their objective and their goals. Then we go out and search and shortlist individual properties that meet the brief. So we get the brief, we find a property, then we select the best one that we find at the time. We evaluate it, we complete an appraisal, we complete due diligence, make sure there's no asbestos or cladding issues, for example. Then we step in and negotiate, organise to get contract reviewed by the solicitor, close the deal, get it exchanged, and then we provide a property manager and attend to the pre and post settlement matters as well. So it's a full end-to-end service that we provide. Saves clients huge amounts of time and also gets them the right kind of property. How do we charge? We work on a fixed fee. I can't put the fees up there at the moment, it's just a page of numbers, but essentially it's between 1.5% to 2%. Anything under $1 million, it's equivalent to 2%, and then a sliding scale up from $1 million to $2 million, where it becomes 1.5%. So, for example, on a 650K investment property, it's a total flat fee of around 14 grand. You pay 3,000 up front, and then the balance of the fee. So how do you justify that fee? Well, as I say, we have a personalised strategy. We give access to a lot of off-market properties. Average turnaround time, Joe, is around 30 to 60 days. So when someone signs our agreement, say, buy me a property, Rich, to when they've executed is around 30 to 60 days.
Yes.
And you have a professional negotiator, typical, often save you more than the fee, potentially, but more importantly, gets you the right property that will grow in capital value. Yes. And that's the mistake a lot of people don't think about. They think they can buy any property in Melbourne or any property anywhere, but no, you've got to make sure you buy in the right suburb, because that will accelerate your wealth big time. A couple other benefits which I can leave you there with, a couple of our values as a company. I guess the key value we present as a company is our care factor. I say to my team, guys, you've got to demonstrate to clients that they don't care about how much you know until they know how much you care about them. That's our ethos, if you like. And there's a comparison. If anyone's a cost benefit, a nut like me, and you want to work out what's the value of using a buyer's agent to doing it yourself, have a look at the slides later and that'll tell you.
And on that point, I've got a real life story where lately we've got a lot of clients that buy either under their independent for investment or under newly established SMS. We have the DIYs and the buyer's agent groups. So in comparison, DIYs, it takes on average minimum 3 months to locate the property. Most of them takes longer than that. But with the buyer's agent, we just had one, they only spent about 2-3 weeks from the start, and they've already secured an off-the-market opportunity. And looking fantastic. So that's probably where the real value of the professional buyer's agents is, right?
Correct. That's it. So let's have a look at some case studies to wrap up, and then love to hear your questions. So a couple of examples. This was an apartment that we just bought, when was it? Just a couple of weeks ago in Melbourne. Lovely couple from Sydney, the interstate investors. It was listed at offers over 450. We got it just under that. It rents for 500 a week. So it's just a simple 1 bed, 1 bath, but really close to university, really close to the tram line. So really affordable property in Melbourne. Yeah, great property. Again, some of these properties aren't great to look at. When you look at the picture, you go, oh, that's pretty average. But honestly, it's about the land content and where it's located. It's not about the beautiful appearance necessarily. Just a classic investment property. We got this 2-bed apartment for 561, rents for 500 a week. Now, it's on a block of 6, but what's interesting is the land value is 90% of the price.
Wow.
Like, this is an awesome buy. So Tass, who is our Melbourne buyer's agent, he's an ex-valuer from NAB. He understands valuations backwards, but this is a really good buy in terms of, as I said, this property, value it in a year or two and it'll be significantly higher.
It's pretty much buying the land and give you the...
Exactly, you got the apartment almost for free. Yeah,
it's crazy.
Right. All right, so this was another one we just bought in February. Again, with the auctions are typically underquoted, so you've always got to watch agents, right? They'll underquote to get the bees around the honey pot. So this was a 3-bed, 2-bath, 2-car home on 658 square metres. This was in the Bayside area down toward Frankston, as I mentioned. We got it for 1.18 and it rents for $8.50 a week. But again, classic investment property, really good for long-term capital growth. So this is one of 3 or 4 properties this client's going to be buying over the next 4 years. Another really good one that we also bought in a similar area. We got this for $680. Sorry, this was, I'm trying to remember the suburb it was actually. I can't remember now. I think it was in the north. 680. Again, this rents for $600 a week. You're down in the southeast corridor, but really close to transport. Another townhouse we got here. We paid $708 for this one. It rents for $640 a week. Not far from Preston. Really close to the shops, close to the tram, close to the cafes. So, and this was for a home buyer. This is a really good one we got in Craigieburn, which is in the northern areas of Melbourne. How come it's just decided to go off? Come back up. There we go. We got this for $575. This rents for $500 a week. Classic 3-bed, 2-bath, 1-car house. Only 10 years old, But to get a 3-bedroom house for $500,000 in Melbourne, wow, I mean that's pretty decent. I mean so it's not a big, it's only on 300 something square meters of land, but that's a great investment long term. Slightly more expensive again down the southeast corner, a place called Langwarrin, down toward Frankston area. Got this for 1.12. Rents for $9.50 a week, so really solid return. But a huge 4-bedroom house, only 2 years old. Really tricky negotiations, but we got this one secured really quickly for our client. Wow. So sometimes with these deals, right, it's all about the negotiation that we do with the agent, having that rapport with the agent. So a lot of interstate buyers, they're not going to have the same leverage that we've got. So my buyers agents are on the ground. They know how the agents work. They're able to weave their way through. For example, this was a first-time home buyer. They'd missed out on about 4 or 5 auctions before coming to us. We managed, their limit was 1.2, and we got it just under their limit for a classic property, little terrace home. It's beautiful. It's a more expensive property. I can't remember where this one is, but this is in, I forget the suburb now. Anyway, I can't move it down. There you go. Move that down. There's the direction. No, Carnegie, sorry. That's right. Let's be precise. 2.56. This was for a home buyer. It would rent for around $1,500 a week, but this was for an expat client looking to buy their sort of dream home coming back after a long time being away. So again, they weren't familiar with the market, really able to help them understand what they need to pay, and we managed to secure this really quickly for them. This is one we just bought a couple of months ago. Again, really good value-wise in terms of land value. Got this for $735. Rents for $770 a week. So what's the yield on that, William? Probably about almost 6%, like that. Yeah, very close. Yes. 85% land value. And you get walk to beach, walk to trams, walk to cafes. So really, really great property. And that was in Elwood. So a really nice suburb of Melbourne. Couple more to go to finish off. Again, this one was in Coburg, 1.3. I've got this in northern suburbs. Classic story here. These particular owners, the owner had a dog and they really wanted to be close to this particular park, which had a creek. And it was funny, the owner and the dog just had such an affinity, but we managed to get a property that literally backed onto this park. So can you imagine, we got it under their budget and the owner and the dog were extremely happy.
Very specific. That's very cool.
This was a lovely expat client that we bought for quite a high price property on the Bayside there. Budget was up to 4. We got it just under that, so about 200 grand at Aspendale. But beautiful, beautiful property there. So I think I've ripped through, Joe.
Okay.
Question and answers. I hope everyone's filled up some question and answers. I can't see them yet, but I'm sure they're there.
Well, thanks for sharing those insights, Rich. And it's clear that a lot is happening in the Melbourne property market, and you've given us plenty to think about. Then I'm sure many of you have the questions, whether it's about the property opportunities, lending strategies, or anything else we've discussed today. This is your chance to ask. And if you're in person, feel free to raise your hands. And if you're online, just pop your question in the Q&A section. And we've got Genius Yuki to help us through the Q&A. Yeah. While we're waiting for the few questions come through, Rich, and here's one I often hear from my clients, if we can just start it. Many of the investors I speak with are wondering if now is the time to buy, or if they should wait for more sort of certainty, which is one of the common questions we get, right? So what sort of advice would you give to someone sitting on the fence?
Well, I guess comes back to my slides before, is that should you wait or should you, buy now? Is I definitely say, buy when you can afford to buy. So don't just buy willy-nilly, but buy when you can afford to buy. If you've got the borrowing capacity, and you just let it waste away, then you've got a wasted opportunity. Like if you're in a business or you're on commission, you have a really good year, that's the year you should be buying, because next year you might be down on your numbers and you may not be able to get finance. So buy when you can afford to buy. And once you're in the market, it kind of gets you used to buying. I mean, for me, buying a property is like buying a loaf of bread. You know, I'm a bit, not blasé, but I'm a bit more, what's the word for it? It just becomes a very natural part of my routine.
Yes.
Yeah, I put a contract down, there's a deposit, you got another one, right? Yeah, good, let's go to the next one.
Yes.
So it's I wouldn't wait, because you're going to sacrifice a lot of time.
Yeah, good question. Okay, let's go through the, yes, the gentleman here.
Yeah, just in terms of apartment prices, what impact do you think the sort of upgrading, better quality new builds have on the average price trend for apartments?
So your question is about new stock coming into a market. Will that raise the price of established stock?
Yeah, is that more driving the
It
price
helps.
increases?
It definitely helps. Yeah, definitely. Because I think any buyer that's buying in a market, they'll look at the new stock versus look at the established stock.
Yeah.
So if the new stock is selling well, that should help to drag up or push up the established property market. Absolutely, it will help. But if developers are struggling to sell that brand new stock, you know, they have to discount it. That will drag down the prices.
Awesome.
Yeah. And that's a good question, because I've been working with a lot of clients in the Up North Shore, and some of them are actually downside there. They've sold their beautiful $5 million, $6 million property unencumbered, then grab money to buy a decent apartment to downsize, close to station, close to shop and coffee. And they are sort of picking between the established apartments or the luxury brand new building. Obviously, I think they're paying a bit more premium on the brand new property, but it's a luxury lifestyle, and a lot of people, you know, love that. So I think it's a really good one to discuss, I guess. Yeah, thanks for the questions. Now let's quickly walk through the questions we have. We've got a few comments on the Q&A. So from Nandish, though you already have an investment property in your personal account, but they say when you set up a discretionary trust, it helps to borrow more. Okay, so this is about lending. I can answer that. So the short answer to this is no, because anything already under your individual names, it's already eats up your borrowing capacity. So setting up the trust, and from that trust going forward, anything in that particular trust or any other trust following that will be pretty much can be ignored by the bank based on the current policy. So the short answer is no. For the first property already under your individual names, you won't be able to get the borrowing capacity back. But anything going forward, yes, you might be able to do that if you set things up right. That's why it's important to discuss with a professional at the very beginning to make sure things are properly set up from the very, very beginning. Okay, thank you for the question. Second one's from Ian. I think the comments, I've always used building approvals as a good guide to buy. I think that's
building inspection.
Yes, building inspection. I think that's a really good comment. Thanks, Ian.
Good time. Do you agree? Okay, when low equals good time, do you agree? And where are approvals currently? I'm not sure what he means by that, but buying when you've got your, as I said, buying when you've got your approval in place is a great idea. Absolutely. And just it's about picking the right location and working out a strategy depending on where you already own property. Are you looking for a high growth property? Are you looking for a cash flow positive property, or a good balance of both? All of those factors come into the strategy and that you need to work out. Yeah.
I'm not sure if that answers your question, Ian, but let us know and drop in the chat box if it's not, then we can further elaborate on that. The other one is, what do you foresee the outskirts region areas from the Melbourne CBD areas?
Will they perform?
Yes.
Yeah, so areas like Beveridge, there's going to be a lot of land supply that's going to be turned into housing in those areas. So, you know, even places like Craigieburn, you do need to be careful exactly what you buy and when you buy those areas. So there is definitely going to be more land. It's a question of when it's released. But I do think the pricing on those, again, it depends on the pricing too of the new stock. So always compare the new stock and new pricing compared to established housing. Because as I say, typically buying brand new properties, you're paying a retail price, you're paying the developer's margin. So probably 99% of what we buy or even higher is established stock for our clients, because we know it represents far better value. You're paying commissions, you're paying developers' margins when you buy brand new. So why pay that when you can buy an established property? And it's not about just getting the tax deduction. It's all about getting the best value you can from the property long term.
Good question. Next one is the proportion of the clients you deal with as a buyer's agent for investment properties or owner-occupier. Good question, though.
Yeah, I guess it depends on the area. So it's not a hard and fast rule. I mean, typically it's 50-50, 50% investment, 50% owner-occupier. In some areas, it's like 70% investment, 30% owner-occupier. You know, we do a lot of investors in Melbourne and Brisbane as well. a lot of owner occupiers in Sydney. It just depends on the market at the time. But we absolutely have specialists. I've got 32 people in my team, and we've got local area on the ground specialists.
Okay, perfect. And I assume that for PBSI, the owner-occupier and investment, you're going to have different strategy with your team to help with the buyer, because the goal and the nitty-gritties are different, right? Okay, okay, that's good. We have a lot of questions.
That's good. Let's rip through them.
That's good.
Right. Can a buyer's agent fee typically be paid from self-managed fund? Well, I'd say generally yes, they can pay that fee from that. So the answer is that one.
It's like running a business, part of the business cost.
Yes. Yeah.
The rental law in Melbourne favor too much on the tenant side. Yes, I've heard about this. And what's your thought on this? It's a good one.
Look, I think, again, like the same sort of laws are being introduced into every state. You know, you have to make sure the building is habitable, the smoke alarms work, the heaters work, you know, the same sort of laws, and the same sort of law about rental increases. Typically only do one rent increase per annum in each state, but typically you're not going to put up your rent more than once a year anyway. So we all say it's more in the tenant's favor, but at the end of the day, if you've got a good property manager, work with your tenant, don't under rent it, but you typically have a good relationship with them and it'll work fine.
Yeah. And a following up question from Henry, do you think that's the reason why investors are leaving the Melbourne market? I think you've pretty much answered that question.
I think it's just a perception thing. People just think it just gets bagged out by the media. Again, just look at the fundamental drivers as I've explained today. I definitely think I've got properties in Melbourne. I'd like to buy more. I definitely think it's got a lot of opportunity to buy well.
Right. Okay, good. Thank you. And another question is based on your case study example. Would you advise your clients to not really invest in the western suburbs, even if it's in location close to the transportation corridors, away from the industrial sites? So
I would say places like, you know, the western suburbs like Melton or Tarneit or whatever, I guess I'd be very careful on those areas. So what I do is even my experts in Melbourne will be able to answer that question even more. But I'd suggest the western suburb is probably less favourable than the southeast, the Bayside areas, just because there's more amenity in those Bayside suburbs compared to the western suburbs. It's just generally a nicer environment, nicer kinds of properties. But having said that, the northeast corridor, there's some areas in the northeast that are still pretty decent as well. So again, it's not a one size fits all answer.
I love this question. It's very specific. Maybe I'll suggest you maybe get in touch with Rich's team to get a more dive deeper with its details. Yes. Next one from Zoe. Joey actually, would you rather buy a house in 20k radius in Melbourne than an apartment with, that's a good one, showing with 90% land content? That's a good question. That's actually
I guess, Joe, it comes down to an individual point about your risk reward. You know, for me, I'd be buying a house rather than an apartment. That's just me, because I could probably afford to spend a bit more on the house. But if I only had, you know, $600,000 or $700,000 to spend, then I'd definitely go the apartment route, because I'd get into the market. I know I'd get something with really good land content and have that. So for me, it's just, the question is not so much house or apartment, but which asset for that value is going to get me the best capital return in the time period I'm looking at.
And just on top of that, I've got something similar, because a lot of my clients are interested to understand whether they should prioritizing the capital growth sort of assets compared to the rental yield hotspots. So what's your view on that? Just maybe
the very first word that came out of your mouth, capital growth.
Capital growth. Okay, so it's more like a long-term plan.
Yeah, for me, look, at the end of the day, you know, a lot of spruikers will promote positive cash flow, but $20 a week in your pocket's $1,000 a year, right? But for me, it's the capital growth. You know, like for me, that's what's going to accelerate your wealth so much faster. Like once I learned how to buy properties and recycle my equity and recycle my debt, wow, I took off. I bought 3 properties in my first year. I started buying properties, right? So once you do that, it's the capital growth that's going to accelerate your wealth. But at some point in building your portfolio, let's say you get to 10 or 15 properties, you're going to need to rebalance your portfolio. But while you're getting there, capital growth needs to be your number one focus. Yes, you've got to get a good rent return, because you will run out of serviceability, and having decent rents improves your serviceability. So for me, my journey to get to, you know, more than 10 properties has been buying a good mix of properties. So I have properties, I mean, I didn't put the slide up, but I've got a granny flat property that it cost me, I think I bought it in, it was the GFC year, 2008, we were just talking beforehand. And I paid $850,000. Now, at the time, I was renting for $700 a week. Now, that same property, I get $2,000 a week for that property, and it's made almost a $2 million gain. So I've had really great cash flow and really great growth, right? So you want to get a good balance of those kind of properties. But if you're going to have a bias toward one or the other, I'd be going for growth.
Okay. Well, thanks for the insights. Hope that answered your question, Joey. Next one is, if you do consider southwest, western corridors for clients, do you think more for opposed to say southeast, eastern suburb, very specific on the location?
I think we should have answered that just before,
Yeah,
so I think we've already done that one.
Yes.
If you're already tapped out for buying properties under Melbourne or a house on the outskirts, if so, where? Oh, if you only have 600, would you buy an apartment? Yeah, so I would. Yes, so the answer to that question, Kevin, I would be looking to buy an apartment if you've only got 600. Yeah,
good. Last question from Ricardo. What do you think about the Brisbane market with a few huge factors going on at the moment, Olympic Games, interstate migration, lifestyle? That's
great question. I love Brisbane. Look, we are buying stacks of properties in Brisbane for our clients as well. 100%. We think it's not just the Olympics that's going to drive that market. The main thing, as you put in there, is interstate migration. There's about somewhere between 90,000 to 110,000 migrants a year moving north to Gold Coast, Brisbane, Sunny Coast.
Yeah.
So that market is going to continue. It was happening before COVID, and it's going to, and that COVID has accelerated that trend. So we definitely think the Brisbane market has a very, very long future, very, very strong future, and you can get really strong yields. So the thing about Melbourne is you probably get a 4%, slightly higher, just around 4% yield. Brisbane, you can get 5.5% yields.
Yeah.
So if you need to get that higher yield, Brisbane is definitely a market to consider as well.
Yeah, perfect. And I think we've got a few more in the chat box. From Edward, which suburbs would you be advising to buy around 800k in Melbourne, Victoria?
Yeah, again, I'd set you up with my individual expert, but I think some of the Bayside suburbs. Average timeline from engaging a property buyer purchase property, as I said, it's around 30 to 50 days. We're pretty quick about it.
And
what do you think? Answered that one.
Yep, that's right. And if you have say 6 capacity, would you buy
I've
apartments? Yeah, I'll pretty much cover that. Excellent. Okay. Any other question from the people in the room? And Lady Naomi? We can talk after the session, I guess.
Yes. Do you guys charge a fixed fee or the
fixed fee?
Fixed fee across the whole Australia?
Yes, correct.
Okay.
Yeah. And then we have local specialists. So basically, myself or Peter Domjan, our director of client strategy, will do a strategy session with you, and then based on what we discuss and recommend from there, then you get allocated to one of our specialists on the ground in the local area. So each of my buyers agents lives and works in their local area.
Okay. Thank you.
Okay, perfect. Well, thank you for such a fantastic session, Rich, and thank you for your valuable insights. You've given us a much clearer picture of the Melbourne property market in 2025. And it's clear while challenge remains, there are also exciting opportunities for those who are informed, prepared, and ready to act. Now, for anyone keen to explore the next steps, whether it's structuring your finance or maximize your borrowing capacity, or identifying the right investment opportunities, both Rich's team at the Property Buyer and our team at Machine Mortgage are here to help. So feel free to reach out, and we'd love to continue our conversation. Now, before we officially wrap things up, Rich, I'd love to finish on a more personal note. 25 years in the business and 49 awards later, you've been seeing the market evolve and help thousands of clients, and obviously build a very incredible reputations. Now, if you could share just one lessons or piece of advice for young investors starting their journey, what would that be?
Oh, good question. Where do I start? Well, log on to my website and just read all of my material. I've got heaps of free downloads, number one. But I would just say, work on yourself. Work on your own mindset. Like I did a lot of the stuff. I used to read a book a week. I'd catch the train into the city, and I'd read a book a week on property investing and property, just general property knowledge.
Yes. And
I'd attend every webinar like this I could go to. So at some point, though, I realized I had what's called paralysis of analysis. I had too much information. And I say there's a point at which you go, you know what, I don't know everything, but I know enough. And I know the person over there. I know William or Joe or whoever can help me get a loan. I know Rich can help me get a property. I know Bob, the accountant, the other end can help me do my tax. And then you've got to take that leap of faith.
Right.
So I think there's a lot of things that hold people back from taking that step because of fear. I think learn to overcome your fears, learn to set up a budget, learn to save money, and learn to get your borrowing capacity as high as you can, as early as you can. And I think if I had my time over again, I'd probably buy property earlier than what I ever did before.
Right. So it sounds like it's about knowledge and the execution and move as early as possible. Correct. Right? Yeah, that's go, Rich. I'm sure everyone here will walk away not just with the market insights, but with a fresh perspective on how to approach their next steps with confidence. Thanks, Rich. Now, just so you don't miss anything, we will be sending out a follow-up email with a replay of this session, a copy of Rich's slides with all the data and diagrams, and also a link to Propertybuyer so you can connect with Rich and his team directly. Thank you all for joining today at Shing Wells Talk, and whether you tune in from your home, the office, or over lunch, it's great to have you with us. And up until next time, stay informed, stay proactive, and happy hunting. Have a fantastic afternoon, everyone. Thank you.
Thanks very much, Joe.
Thank you. Thank you.